Okay, let's jump right into this explainer. When most of us think of Warren Buffett, we immediately picture this folksy, grandfatherly figure from Omaha, right? A guy who just has this magical, almost supernatural intuition for picking winning stocks. But look, we need to move beyond that generic myth. The reality behind his success is far more rigorous, mathematically precise, and structurally ingenious. Today, we're going to completely deconstruct the actual mechanical and psychological architecture behind how Buffett, alongside his legendary partner Charlie Munger, built one of the absolute greatest wealth compounding engines in human history. To really understand the sheer scale of what we're analyzing here, we have to look at the numbers long before Berkshire Hathaway was a global behemoth. Imagine this. A 25-year-old Warren Buffett pulls together just $105,000 from 7 limited partners, tosses in a mere $100 of his own money, and starts a partnership. Over its 13-year run, that partnership generated a staggering 31.6% annualized return. To put that into perspective for you, the Dow Jones Industrial Average was returning just 7.4% a year during that exact same period. He wasn't just beating the market, he was completely eclipsing it. Section 1. The Graham-Dodd Foundation, exploring Buffett's value investing roots. So to figure out how he pulled off those early numbers, we have to wind the clock back to the foundational architecture he learned at Columbia Business School under Benjamin Graham. Graham basically created a way to analyze stocks that was entirely detached from the emotional roller coaster of the market. He taught this cold, highly mathematical approach to finding deeply discounted investments. He looked for what he called cigar butt investments. Picture a discarded cigar on the street. It's ugly, nobody wants it, but it still has one good free puff of value left in it. Specifically, Graham screened for what are known as net securities. These are companies trading at a massive discount to their net current asset value. Think about that for a second. You are literally buying a business for less than the cash and liquid assets it has sitting in the bank, even after paying off every single liability. It's basically free money. Graham taught that daily stock prices are just emotional offers to transact. So true risk isn't about a stock bouncing up and down. It's the probability of permanent capital loss from simply overpaying. Section 2. The Partnership Era, 1956 to 1969. During this era, Buffett brilliantly aligned his own paycheck directly with his performance, taking a fee only if he beat a 6% hurdle rate. And to hit those crazy numbers, he executed what he called scuttlebutt, which is basically exhaustive, boots-on-the-ground primary research to pull off these incredible mini heists of intrinsic value. Check out this slide. Take Sanborn Map Company. The stock traded at 45, but its internal investment portfolio alone was worth $65 a share. So Buffett swooped in, accumulated controlling stake, and forced them to separate the mapping business from the portfolio to unlock all that trapped value. Or Dempster Mill, trading at $18 with a $72 book value. He took control, brought in new leadership, sold off excess inventory, and turned dead assets into cold hard cash. And then there's American Express. Their share price completely collapsed in 1963 because of a massive fraud scandal. So what did Buffett do? He literally went out to restaurants and stores to see if regular people were still using their Amex cards. Once his scuttlebutt confirmed the brand itself was totally fine, he aggressively bought into the temporarily distressed company. But here's the catch. As the late 1960s rolled around, the market got super speculative and frothy. Suddenly, those statistical net bargains just vanished. The pool dried up. Now, most Wall Street guys would have just lowered their standards to keep collecting fees, right? Not Buffett. He did something almost unheard of. He dissolved the partnership in 1969. He essentially said, I can't find good deals, here's your money back. He offered his partners cash or shares in a struggling textile manufacturing business that the partnership had taken control of. And that little textile mill was called Berkshire Hathaway. Section 3. The Insurance Float Engine. Zero-cost leverage. Now, this is the major turning point of our explainer. This is the rocket fuel that transformed a dying textile mill into a global powerhouse. Up until now, we've been talking about a really smart stock picker. Now, we are talking about structural genius. In 1967, Berkshire bought National Indemnity for $8.6 million, which gave Buffett access to something called float. Insurance float is simply the capital collected upfront as premiums, which the insurance company gets to hold and invest before they eventually have to pay out claims. Normally, insurers park this in boring, low-yielding bonds, but Buffett repurposed this float as permanent investment capital. And here's where the absolute magic happens. If an insurance company is run well and collects more in premiums than it pays out in claims, the cost of holding that capital actually becomes negative. Let that sink in. It effectively means policyholders are paying Berkshire Hathaway to hold and invest their money. If you look at this comparison, it perfectly illustrates why float is an absolute financial superpower. Traditional leverage relies on borrowing from banks or bond markets. That comes with interest rates, credit spreads, and worst of all, margin calls. When the market panics, banks demand their money back, which forces you to sell your assets at the exact wrong time. But insurance float? It comes from everyday policyholder premiums. It operates at a negative cost, and it organically replenishes every month as people pay their bills. And most importantly, there are zero margin constraints. No one can call that money in. So while traditional leverage forces people to liquidate during a market crash, float gives Berkshire this massive, non-callable pile of cash to aggressively buy up assets when everyone else is panicking. Let's look at GEICO to see this engine actually running. Buffett first checked out GEICO way back in 1950 as a student. He literally took a train to Washington, D.C. on a Saturday and figured out they had a massive cost advantage by selling directly to consumers. Fast forward to 1975, GEICO hits severe financial trouble under reckless management and the stock tanks to $2 a share. Buffett realized their structural advantage was still there, so he partnered with the new CEO and bought massive blocks of the company. By 1995, he bought the rest of it for $2.3 billion. And check this out. By 2022, GEICO alone was generating an unbelievable $28 billion in float reserves, acting as the primary engine for Berkshire's investments.
Section 4. Finding Economic Moats. Discovering Structural Advantages.
As Berkshire's capital scaled into the billions, Buffett ran into a mathematical wall. You just can't invest billions of dollars into tiny, discounted cigar-butt companies anymore. And this is where the extraordinary mind of his legendary business partner, Charlie Munger, fundamentally reshaped the architecture of Berkshire. Munger convinced Buffett to move beyond traditional deep discount value investing. Through Munger's multidisciplinary mental models and focus on rational decision-making, the strategy completely evolved into buying exceptional businesses at fair prices. They started hunting for economic moats, which are basically structural advantages that protect a company's profits from competitors. This could be a cost-based moat like GEICO. It could be immense pricing power and brand loyalty. It could be high switching costs where it's just too painful for a customer to leave. Or it could be platform network effects. Munger's influence proved that extreme patience and holding on to a truly great, well-defended business was far more lucrative than flipping mediocre ones. The perfect example of this Munger-inspired evolution is Coca-Cola. After the 1987 stock market crash, they initiated a massive 9% stake in Coke. Why? Because Coca-Cola had global distribution, it required very little capital to grow, and it had unmatched brand equity. Because of that massive economic moat, it generated incredibly high returns internally. See, when a great business retains high returns on its own capital and buys back its own stock, your wealth grows automatically. You don't have to constantly trade, the business just sits there and exponentially compounds the wealth for you.
Section 5. Navigating Market Cycles. The Marx-Buffett Synergy.
But managing this vast empire of capital requires immense patience and psychological discipline. And this brings us to an incredible intellectual overlap with another legendary investor, Oaktree Capital's Howard Marks. Both Buffett and Marks, heavily relying on the kind of rational mental models Munger championed, use what's called second-level thinking. First-level thinking is superficial. It's the consensus. It's the person who looks at a chart and says, wow, this is a great company with a great product. I'm going to buy the stock. But second-level thinking goes way deeper. It asks, okay, yes, it's a great company, but does the current price already reflect that greatness? Is everybody already expecting it to be perfect? What happens if growth slows down even a little bit? Second-level thinking is all about figuring out if you are getting a margin of safety or if you're just overpaying for a really good story. When you look at this matrix, you can see how universal these principles of rationality really are. It doesn't matter if you are Warren Buffett buying high-moat corporate stocks using zero-cost insurance float, or Howard Marks buying distressed corporate debt using private equity funds. To achieve superior performance, you absolutely must be countercyclical. Market cycles are basically just a giant psychological pendulum swinging between ridiculous optimism and terrifying pessimism. To win, you have to be highly defensive when everyone else is getting greedy and credit is easy. And you have to aggressively deploy your capital when institutional panic drives prices way below their actual fundamental value. Which leads us to completely throw modern portfolio theory out the window. Wall Street tries to tell us that risk is just price volatility, basically how much a line on a chart bounces around. Graham, Buffett, Munger, Marks, they all completely reject this. True risk is not volatility. True risk is the probability of a permanent loss of capital. If a stock drops 20% during a market panic, that isn't risky if the business itself is structurally sound and you have the patience not to sell. But overpaying for a mediocre business that eventually goes bankrupt, now that is true risk. This entire framework is built on preserving your long-term capital above everything else. So Warren Buffett didn't become a financial icon just by getting lucky and picking a few good stocks. He and Charlie Munger built a brilliant, zero-cost leverage engine. They ruthlessly demanded wide economic moats, and they applied incredible psychological discipline to exploit market cycles. Which leaves us with this final thought for you to take away today. As you look at your own portfolio and your own financial choices, are your decisions being driven by the emotional, consensus-driven reactions of first-level thinking, or are you applying the disciplined, rational patience of second-level thinking to navigate the cycles of your own financial future? Let us know in the comments.